The insanity continues. If you follow the stock market, you've probably heard a lot about the financial crisis of 2008. The federal government has backed mortgage lending for over 80 years through several policies, initiatives, and organizations. Millions of middle-class families were able to purchase homes thanks to this support. Cheap credit and lax lending rules contributed to the housing bubble that sparked the financial crisis in 2008. But when the bubble collapsed, the banks were left with trillions of dollars worth of worthless investments in subprime mortgages. Many people lost their homes, money, and livelihood following the Great Recession. Since the Great Depression, this global financial crisis has caused stock markets to have fallen by nearly 50%, making it the worst since that time. The fundamental reason for this was that everyone at the time believed that the housing market could never fail, except for one individual, Michael Burry. So how did the crisis start? But before that, allow me to welcome you to another video of Finance Sense, where we cover all the latest trends in the financial markets and the economy. In this video, we'll hear how Burry foresaw the catastrophe, what caused it, and how it impacted all parties concerned. We'll also learn whether or not there's a chance it may happen again. So make sure to leave a like, subscribe if you're new to our channel, and turn on the notification bell to keep posted. With that being said, let's start. A house price bubble in the US and abroad was driven by years of historically low interest rates and lax lending rules, which laid the groundwork for the financial catastrophe. As usual, things got off to a good start. The Federal Reserve reduced the federal funds rate from 6.5% in May 2000 to 1% in June 2003 in response to the bubble crash and a slew of corporate accounting scandals. By making money inexpensively available to consumers and companies, the economy was supposed to be stimulated. Home ownership eventually reached a saturation point as interest rates began to increase. The Federal Reserve began hiking interest rates in June 2004. 2 years later, the rate hit 5.25% and remained until August 2007. It ultimately resulted in a financial and economic catastrophe that cost many average individuals their jobs, money, houses, or occasionally all three. Additionally, most American homeowners discovered that they owed far more on their mortgages than the value of their homes. During the worldwide mortgage crisis of 2008, trillions of dollars went to waste, yet Michael Burry profited greatly from the collapse. Not only did he anticipate this crisis, but he also set himself up to gain from the world's demise. Therefore, how could Michael Burry predict this and place a significant gamble against the American home market? Michael Burry, a physician who switched to investing, sees himself as a value investor and regards Warren Buffett and Benjamin Graham as his mentors. In 2000, he launched Scion Capital, a hedge fund. He began concentrating on the subprime market in 2005. After closely examining the mortgage lending techniques used in 2003 and 2004, he started trying to warn his clients about the terrible meltdown in 2005. Burry foresaw that the housing bubble would pop in 2007. This takes us to a crash that is about to occur. According to his analysis, subprime mortgages, particularly those with lower rates and the bonds based on them, will lose value when the actual rates are replaced with noticeably higher ones. As a result, he decided to short the market and convince major financial firms to sell him CDSs on risky subprime deals. In a CDS, the seller of the CDS promises to compensate the buyer if the debt fails. In essence, it's purchasing insurance against asset default. Burry was mocked at the time by everyone. Burry, though, was able to see what others chose not to. The aim of the housing bubble was to stimulate the economy by lowering the cost of borrowing for households and companies. As a result of borrowers taking advantage of the cheap mortgage rates, home prices began to rise rapidly. Even some high-risk borrowers, individuals with bad credit histories or none, could fulfill their dream of owning a home. The Wall Street banks bought the loans the banks had sold to them, and those banks bundled them into what they said were low-risk financial instruments, such as mortgage-backed securities and collateralized debt obligations, or CDOs. Soon, there was a significant secondary market for marking and selling subprime loans. In light of this, how did Michael Burry foresee the crisis? In 2003, Burry noted that mortgages were being issued to subprime borrowers at an increasing rate. This was the first warning sign. For lenders, subprime borrowers pose a greater risk. They have worse credit scores. Loans that are provided to them are thus viewed as risky. Then, those risky loans were bundled. Later, they were released to the market as securities backed by mortgages. MBSs, or mortgage-backed securities, are bonds backed by mortgages and other real estate loans. Burry chose to gamble after seeing an opportunity. By 2005, he had grown confident in this impending collapse and had shorted the housing market by developing the credit default swap as a financial derivative instrument. Burry was required to pay a premium since it insured him from a payout in the event that the housing market started to decline. At first, the premiums he was paying affected the profits his business was making. He experienced investor revolt due to certain investors demanding their capital be removed out of fear of his projections. The crisis began to develop later in 2007, just as Burry had foreseen. He earned $100 million on his gamble against the housing market, while his investors made $700 million. He observed the subprime market's fragility as millions of borrowers with low incomes and no assets purchased houses using a lot of leverage. Making no down payment on mortgages they couldn't afford when interest rates inevitably rose was a common practice. This begs the question, how did credit rating agencies' complacency contribute to this crisis? Burry claimed that credit rating agencies were lax and would suffer significantly due to this. Agencies assigned a BBB or investment-grade rating to the security's riskiest components and a AAA rating to the safest 80%. Michael examined that 20% of securities were connected to interest-only mortgages, despite being so-called subprime structures, while 50 to 70% were attached to cash-out refinancing, and homeowners exchanged their mortgages for even larger ones. Finally, 30 to 40% of the affected borrowers had FICO credit scores lower than 600. He believed that 15 to 25% of home loans had LTVs of 90 or more. He continued by stating that second liens were present on 40% of loans. If the borrower files for bankruptcy, another loan will be paid off first. In contrast to the previous year, spreads on BBB securities were 150 bps instead of 300 bps. This indicates that investors did not consider these items to be in need of rescue. Burry finally earned millions of dollars thanks to his contrarian bets. Burry made money by betting against the odds on multiple occasions. When the S&P 500 fell by 11.88% in 2001, his hedge fund, Sign Capital, grew by 55%. These extraordinary gains were made possible by making contrarian bets. At the height of the internet bubble the following year, he shorted expensive tech stocks. His hedge fund gained 16% once more, while the S&P 500 lost 22.1%. The S&P 500 gained 28.69% in 2003, a spectacular year for the stock market. This put many Americans through severe hardship. Their houses had lost some of their original value. They owed money to their lenders, therefore they could not sell their homes. If they had adjustable rate mortgages, their expenses would increase as the value of their homes decreased. The most vulnerable subprime borrowers were forced to continue paying for mortgages they couldn't afford. Michael Burry's hedge fund Sign Capital once more outperformed the market by generating 50% returns. The head of Sign Assessment Management revealed to New York Magazine in December 2015 that he had reoccurring nightmares about an airplane crashing when the property market collapsed in late 2007. He said in an interview that he was aware of what was happening, but that neither he nor anybody else could stop it. Burry continued saying that on December 31, 2007, he was too distraught at the tragedy to leave work and visit his family at home. Soon after, he tweeted, The U.S. government issued data revealing that sales of new single-family houses declined by about 17% month over month to 591,000 units in April, which was considerably below the consensus projection of 750,000 units. In addition, the benchmark S&P 500 index fell as much as 2.5% on Tuesday and ended the year 18 points lower. The highly tech-weighted Nasdaq plummeted as much as 3.8% and is currently down 29% for the year. Does this indicate that a new catastrophe is about to develop? Shortly after, Burry had his chance at fame, and The Big Short, a film about how he predicted the 2007 and 2008 housing market crisis and gained a fortune doing it, was inspired by his story. He frequently compares the bubble that made him famous and the rise in asset values during the COVID-19 pandemic. Michael Burry recently gained attention for his belief that the stock market would soon reach historically low levels. He recently asserted that the current recession may be much worse than the one that began in 2008. What do you think, though? Does Burry seem to have a point? Hi, it looks like you've reached the end of this video. Thank you for watching this far. Please subscribe and give a like if you enjoyed it, and comment your thoughts in the comment section below. This is Finance Sense, helping you keep up with all the latest trends in the financial markets and the economy. See you around!